All right, perfect. Awesome. Well, guys, welcome aboard. I appreciate everybody joining us here today. I've got a great panel. We've got a great panel here. Sean O'Neill is also supposed to be joining us. He got distracted. He's a vice president at U.S. Bank. He will be joining us by the end of the meeting, hopefully, but he had an issue come up that he had to deal with. So, in the interim, we have an excellent panel, and let's just kind of go around, everybody, give them a quick introduction. Henish, why don't you start us off here?
Yeah, sounds good. Thank you for having me on. I've been in this industry for almost 20 years now, starting off with mortgage sales, servicing. Coincidentally, during the last recession, I actually used to run the foreclosed homes department for a bank. After that, I spent a couple years consulting for the servicing departments of larger banks. And since 2013, I've been flipping homes, and now I own a construction company as well. So I'm a real estate broker, own a construction company, and I serve as an investor here in San Diego.
Great. Thanks, Henish. Thanks for joining us. John?
I'm Jon Hamby. I'm a managing partner of Fortis Legacy Partners. We're a multifamily office for real estate families. We manage about $500 million worth of real estate assets. I also own a brokerage company called Red Strategies, and we've done about $1 billion in transactions in San Diego so far on the commercial real estate side. I'm happy to be here.
Awesome. Thanks for having us. Chris, why don't you jump in?
Gladly. Thank you. I'm partner at Gupta Evans along with Ajay Gupta here. We're a real estate and business litigation firm with a bankruptcy and insolvency part of the firm as well. Focusing a lot on real estate litigation lately, particularly the pre-litigation things given the courts being closed. It's been busy, it's been different, but I'm excited to talk to you guys all about kind of the new developments and what to expect going forward.
Great. Last but not least, we've got Mark Kagan.
Hello, I'm Mark Kagan. I'm a licensed attorney, strictly transactional, and it's my practice. I don't litigate at all. Predominantly lately, I've been helping tenants and landlords negotiate more meaningful solutions than you're finding through the emergency orders that the governor and the local municipalities have passed. And then with those orders, there's direct edict from the Fed to the banks to allow for deferment for landlords to defer their mortgage payments. So there's been a new round of property owners that I'm working with to take that message to their banks and avoid problems with the banks down the road and defer those payments.
Great. I'm Ajay Gupta. I'm an attorney with Gupta Evans. I'm one of the principals there. And I'm a certified bankruptcy specialist. My practice focuses on bankruptcy and real estate litigation. Everybody on the panel here, we're all colleagues, friends. We've known each other for years for the most part. I've had personal business relationships with each and every other person here, and I wholeheartedly understand that they are all experts in their respective fields. And I thought that this would be a great group of people to get together and share ideas because, and we were on this call a little bit beforehand, and unfortunately, there's very little empirical data that's out there just because everything is so new. So what you're going to get here is a lot of, this is what I'm seeing. This is what's in my practice, because these are the people that are on the front lines of this stuff and dealing with the day-to-day. So I hope everybody enjoys this and we can get a lot out of it. Let me see here. Where did we want to start here? So I'd just kind of like to start with a discussion about the marketplace for commercial and residential properties. So I'm going to have John and Henish. They're really on the forefront of commercial and residential. I'm going to have them lead off with that discussion. But let's start with the obvious, and that is valuation. What are you guys seeing? Where is it going? What is going on with current valuations? I think that's the 10,000-pound gorilla that we're going to be talking about indirectly or directly for the rest of this call.
Sure, I can start. I know with appraisers, they can't do valuations based on potential future values. All they're looking at are sold comps or active comps and taking a look at what's just recently happened as their best indicator of value. With that being said, I've heard a lot of anecdotal information that it's hard to get appraisers out there to the properties to do them because a lot of them don't want to work, or some of them are charging a huge amount of fees in terms of instead of a $500 appraisal fee, they're charging $1,500 for hazard pay. And that's just on the residential retail side. From the business owner side, as an investor buyer, I know all of my lenders, about 3/4 of them that were credit line lenders or hard money lenders for buying investment properties in poor condition, have dropped out of the business, not lending at all. The ones that remain have increased how much down payment they want, increased their rates and their fees. And additionally, my brokers that are on that side have said, hey, take your after repair value, what you think this house is going to sell for, and subtract at least 10%, if not more, to be on the safe side.
Yeah, I'm seeing some similarities between the residential and commercial markets. Commercial, it's very sector dependent. So you're going to see very different valuation trends on things like hotels and restaurants than you will in cold storage, for instance, right? That's the yin and the yang of commercial real estate right now. Cold storage is doing really well as grocery chains try to figure out how to meet the demand locally. And then on the flip side, you've got the hospitality industry that's just absolutely getting killed. And appraisers have a tall order in front of them to try to figure out how to manage those disparities, because it's going to be very, very different. And I agree with Henish. The lending environment is very quickly contracting. Debt coverages are beginning to grow. They're wanting to pull some money off the table, and a lot of the hard money guys have just absolutely stopped lending right now. It's not 100% of them, but it's conservative is the day right now.
I've heard that some of the private money lenders, the hard money lenders, are starting to get margin calls from their warehouse lines, and that's pretty painful as well.
True.
So the margin calls from the warehouse lines, that must be based on decreased valuations, right?
Correct.
Like, so they're coming in saying, hey, we're dropping valuations across the board, and so therefore you have to, come up with additional collateral, like from what you're seeing then.
Exactly right. Yeah, that's what I'm hearing, and that's why some of the companies like, we can't afford this margin call. We're just going to fold.
So John, you touched on something that I was curious about, because we got an email from a client today talking about converting their Airbnb into just a normal residential lease. Are you guys seeing any of that going on? Like the hospitality industry, as I mentioned, is just getting crushed. Have you seen that, or what are your thoughts on that?
It's not coming across my desk directly. I don't deal with a lot of the Airbnb side of the business. So if Henish has actual data, I would turn that over to Henish.
Yeah, absolutely. My management company that I work with locally, because I have an Airbnb with my guest house, and they said that their volume, they manage over 200 properties coastally in San Diego. They said their volume of rentals is down to 10% of pre-coronavirus. So pretty much everyone has canceled all their travel plans. I've quickly changed mine over and published it on furnishedfinder.com, and I'm trying to advertise towards traveling professionals or traveling nurses that need furnished accommodations, because those people are still moving around and having to transact, especially to places where there are hospitals that might need that extra support. So I'm trying to find tenants that might stay for 1, 2, 3 months or longer, even if that means that I can't have it rented out short term for the Airbnb type factor. The thinking is, and the optimistic hope is, that once these travel restrictions are lifted, that people are going to go stir crazy and want to go travel and fill these places up and pay premiums. But that's the one side of the perspective of wishful thinking. The other side is we might not travel and do things the same way that we do in the past that we might in the future. That might all change. So I just always like to be prepared for whatever case that scenario might be.
So Mark, are you seeing anything on the Airbnb front, conversions, anything like that? I mean, you're in that transactional environment as well.
Yeah, I've had a few touches with it where there were, they were kind of isolated individual matters. I have a client that wanted out of their lease because of the COVID thing. Interestingly, the landlord was willing to let him go because he can make it's a beach property and he can make a ton of money in the summer through Airbnb. And my client paid me to negotiate a termination agreement and get that all done. And then literally in the course of 24 hours, he completely did a 180 and said, no, I don't want to do it. I can't rent my place anymore. I'm not letting you off the hook. So that was, I'm sure there's a lot of that going on. Interesting that Henish made a comment about the hard money groups. There's a lot of, I'm seeing now kind of like a new little cottage industry. All of a sudden I've drafted probably a dozen notes and deeds of trust from people that weren't traditionally hard money lenders because people couldn't get money from their typical hard money lending sources. So there's a lot of guys that are, real active in factoring, for businesses and things like that. Normally wouldn't make hard money loans related to real estate, but the numbers were too good. So they're opportunists to a fault. And all of a sudden they want to make loans on property and all of a sudden be a hard money lender. And so as much as I'm trying to talk them back from the edge of the cliff, they're jumping over like lemmings. So I'm writing up those notes and those deeds of trust.
Let's not forget though, right now it's still very, very early, right? A lot happened very quickly this time. I hear people try to compare this to 2008 and it's not like 2008. It's just the closest thing we have to a benchmark since the Great Depression. But this thing's very much evolving. And so to try to figure out where valuations are going only a month or so into any kind of stay-at-home order or true interruption in the local economy or the U.S. economy, I think it's all going to be conjecture, right? If you look at January of this year, we were already seeing a slowdown across product types compared to Q4. So Q1 to Q4 is hugely different, having very little to do with the coronavirus, but just in general, sales volume was down across industrial, office, apartments. I mean, everything was starting to contract anyway. This just pushed it over the edge.
So a couple of things that I've discussed in the past when I would get called in for market outlooks and things like that, and I'd flip it and say it's a market lookout type thing. But the things that they always tell you to look out for are the inverse yield curve, right, which happened briefly early in 2019. Feds lowered rates, kind of pushed the recession down the road. Meanwhile, earlier this year, we had the stock market starting to crash as a result of coronavirus before we had our stay-at-home orders in March. And I think that might have trickled down into those kind of factors that John was mentioning. And then finally, the home builder activity just last month was still pretty confident in terms of their confidence of building and stuff like that was over 70, and anything over a 50 on their scale is pretty good. It dropped to about 30 this month. So home builders are freaked out. They're not being able to build and they don't think they can move that product once they do finish a house. So it takes 3 to 6 months to build a house. And so home builder activity is also a pretty good leading indicator of what's coming in the near future.
Wow. Yeah. I mean, and I don't want to engage in conjecture. And I know I sent an email around to you guys about, I don't know how long this thing is going to last. And obviously that's, to echo John's point, is that's the key in understanding what the impact is going to be. I mean, if this thing is 6 months, it's very different than if it's 2 months. But, what I'm seeing and what I'm like, and I think for the purposes of these conversations, I think we have to assume we're getting stay-at-home orders from courts. So, the Central District, the Southern District, they're basically pushing everybody out until June 1st. And the common wisdom is a return after June 1st is not a full-bodied, full-throated, hey, everybody's business as usual. There's lots of industries which are going to return at 50%. There's some industries that aren't going to return. I don't think I'm going to a football game in the next 12 months. Okay, I ain't jumping on a Carnival cruise line in the next 2 years. Okay. There's a certain reality to these circumstances, but I think we have to assume that with a 2-month slowdown and a 50% a return to work, it's going to have a dramatic impact on a lot of things, including, restaurant workers, we were talking about that earlier. It's just, there's a trickle down effect that's associated with a 50% return to restaurants in terms of the ability to rent those spaces, what's going to happen on the commercial side and the residential side. So a lot of speculation there, and I appreciate you guys engaging in that conversation. But I guess what I want to know now is what happened to most of the sales that were in the pipeline before, call it on March 7th, in escrow, hard money, and then by March 15th, everything was done. What happened to those deals? Did those go forward? Is there any deal flow going on right now? When do we expect, and where there is interest, how are we even doing showings?
So go ahead, John.
I can tell you that on March 1st, I had 22 active deals happening, right? Which is a lot in a month. There are 4 active deals right now. And that's the disparity, whether those are leases, whether those are purchases, hard money or not, just that should show the overall activity. Anybody that can hit pause did hit pause. And the only deals that are remaining have some kind of time pressure. Some of them are exchanges, and you've seen the recent news that the IRS has loosened the guidelines on exchanges and extended some of them with very, very particular circumstances attached to it. But right now, on a transaction basis, the only deals happening are deals that have to happen. Everybody else is just on the sidelines waiting and watching.
On the residential side, we're seeing that if its property is worth less than $850 or so, that's kind of roughly the threshold of properties that are still selling. Under that price point, there's still velocity and people are buying. You might not get 6-10 offers on a property like you did 2 months ago, but you're still getting 2 or 3 offers. Like we literally just listed a property today, 4-bedroom in Spring Valley for $565. I've already got calls that we're going to get multiple offers tomorrow on that property, right? Meanwhile, I've got a listing in Rancho Santa Fe for $1.7 million, a house in Mount Soledad for $1.5 million. I'm barely even getting calls or showings on that. We've done big price reductions on those houses that should have sold for $100,000 or $200,000 more 2 months ago. So the higher end properties, I think, are people, and this is just generically speaking, that are probably more impacted by the market because they are self-employed or they invest and they get money from the stock market, versus the people that are buying at $800,000 or less that might be more still white collar, but maybe wage earners because they're engineers or doctors or nurses. And that's the kind of buyers that I'm seeing coming through that have stable jobs. They're still getting paid. And the point is that there's interest rates are still really good. And I did a table for AJ, and I've presented this in another media as well, is that people forget what the interest rate is right after a recession. So if I asked you guys, what was the interest rate, the best mortgage rate you could get in 2010, 11, 12, you might not remember, but it was like 7%. It wasn't cheap. So if you can get a mortgage today at 3.5%, and if prices drop 5 or 10%, but then mortgage rates are 5.5 or 6 or 7%, that extra interest that you pay in your house more than offsets any kind of price decrease there, savings that you might get by waiting. So it's a more of a complicated calculation. It's not a one-dimensional, well, if a house is $700,000 today and then $600,000 1 year from now, obviously it makes more sense to buy it 1 year from now. But if the interest rate is double, then maybe it doesn't make sense. So please make sure you go with your professional to finish that calculation, because it's not a one-step process. This is a 3-4 step calculation to see if it makes sense when you're estimating, does it make sense for me to wait for prices to drop potentially in the future, knowing that rates could go up substantially?
Yeah.
So I've had a number of transactions, about 7 or 8 of these, where it was exactly those scenarios where you described, AJ, where money had gotten hard, people were moving along, and all of a sudden this thing comes out of left field and they're kind of stuck. And it was either sellers that were in a bad position where they needed to sell the house because they were trying to get into another one. That was a typical call. Or it was a buyer who was wanting to get out because they couldn't get their financing, or they just were worried about the market. What was interesting about every one of these things, when I really scrubbed it and got to the root of it, and all these properties were over $2 million. And when I really scrubbed it and got to the root of it, I figured out that the majority of people that were doing what they were doing is because they didn't get to where they were by paying too much for property, and they were doing what they could to basically, wait it out and tread water to see what kind of discount they were getting. So once they realized that, that probably wasn't going to happen, they just went through with the transaction. But there was one that it kind of imploded, and there's some litigation partners of mine that are working on it. But all the rest, all just kind of went full steam ahead once they realized how foolish they sounded. And
we have one that, the term of art right now in lawyer circles is force majeure, right? Like, I mean, this is the act of God clause that is read into any contract. And, at what point is this, does this qualify as a force majeure? And, I'm sure I'm not looking forward to being on the front lines of that litigation, because there's no way to win that. It's just,
it's a mess. I mean, I'm sorry to cut you off. I mean, because it's so subjective. And I mean, you have the car forms at least have that force majeure addendum or that COVID addendum that they're trying to include in a lot of these purchase agreements to try and just delay things and maybe stick it out. But both parties have to agree to that. So if you're not going to
Yeah, it's
agree to
elected.
that, then you're talking about force majeure. But if it becomes, a little more difficult to pay, but you still got the money, that doesn't mean you get out of the contract. I mean, if this isn't a fire that burns down the house. This is something totally different.
Right.
So it becomes, those
Chris?
lawsuits are going to be really interesting.
Chris, you mentioned the addendum to the car forms. Can you explain to people what that is?
Yeah, and I'll mention that. I think Henish probably can get into it too. It's essentially a lot of these car forms obviously don't address for a pandemic, and certainly not this 100-year pandemic.
What is a car form? I'm sorry. So just back up for one more step here. So
the California Association of Realtors has a lot of standard forms that are typically involved in these residential purchase and sale agreements, whether that's disclosure documents, that's the agreement itself, the purchase, escrow instructions, things like that. So the California Association of Realtors came out with a document that, in light of COVID, we agreed to delay the close of escrow by X amount of time, or we agreed to cancel the whole sale and everyone walks away, or other, and you can include whatever you want. But the reason is COVID has impacted people in a variety of ways. There's a lot of uncertainty, as everyone's mentioned so far. So, what is possible? So if someone's working in a job that is on shaky ground, they may not be able to afford their mortgage or what they were loaned, a month ago, in 6 months from now. But the seller has to agree to that, or the buyer has to agree to that too. This goes both ways. And if they don't agree to that, then you're kind of in a tight spot.
So these forms essentially are forms that were pushed out by the California Association of Realtors in order to encourage deal flow, to encourage people to make offers with the understanding that there may be some caveats that are nested in issues that are common to coronavirus. Is that accurate, Henish?
The way I've read them, and I try to send out a link for them, but I've got the 4 documents up in terms of what they say. They're basically all disclosures saying that if anything happens, you can cancel without penalty, is effectively what they all say. And then there are also warnings for listing agreements and also for showings. So now for my showings this afternoon, you have to sign a document that says that, hey, we've done our best to make sure there's no coronavirus in the house, but you might get coronavirus. We don't advise you to go see the house. It's basically what it says. It's just trying to hold us harmless for liability, because I can't keep track of everyone that's coming in and out of my vacant houses. We're trying to with the call before showing on the lock boxes, but then also allows you to extend escrow without penalty or cancel escrow without penalty, even if you're past your contingencies, because, wouldn't it be hard to state that, yeah, Corona has affected your business or your livelihood or whatever it might be. And it'd be, we'd have to hire you guys to go to arbitration and mediation to fight it. It'd be pretty hard to disprove that coronavirus has affected everyone here. Whether you have a good paying job or not, you've still been impacted because now your house cleaner can't show up. Who knows? All these things have happened.
Yeah, I had to sign my PPP saying that I was impacted by coronavirus. I didn't have a hard time doing that.
No, not at all. It wouldn't be hard to prove it. It wouldn't be. I mean, because you can't. Your courts are closed. I mean, that's a fact, right? Your courts are closed.
So, guys, I want to kind of segue out of valuations and purchase and sale issues, and I want to move into landlord-tenant issues. And I guess before we jump into that, I was going to ask Chris to give us a quick 101, because there's been a lot of moratoriums on evictions. There's a lot of poor drafting of laws. I'm sorry, I know this is going to be tough, Chris, but that have come out, orders that have been issued, and even conflicting orders that have been issued. So for San Diego and maybe even Southern California as a whole, give us the 3-minute breakdown of what it is that you can do as a landlord and what your rights are as a tenant.
I mean, so to reiterate, it's very haphazard. It's very on the fly, and there's a lot of different sources that landlords need to refer to before kind of pursuing anything, especially depending upon where you are. So California, for instance, we can go high level. With California, the Governor Newsom issued the order, I think about 2 weeks ago,
16th.
or 3 weeks ago now, almost a month, what is effectively an eviction moratorium. But what that really only did was prevent a landlord from enforcing any eviction order. So if you can still issue a 3-day notice if you're a landlord. Again, this is California as a whole. I'll narrow it down to local issues in a second. And it was really high level. It didn't do a lot. It essentially just bought tenants some time from getting kicked out of their house, 60 days. But then you have all local municipalities that have all created their own separate orders. So the city of San Diego, for instance, is pretty encompassing, whereas the state of California only applied to residential issues or residential tenancies. City of San Diego is commercial and residential, and it prevented landlords from taking, quote, any action to evict these tenants. So that includes issuing a 3-day notice to pay rent. So assuming that the tenants can comply with the requirements of these orders of proving that, one, providing notice to the landlord that they are affected by COVID, I can't pay rent, and 2, giving documents at a predetermined time evidencing that, then a landlord can't issue a 3-day notice and terminate the tenancy. They can't file an eviction.
So say that again. That's really important. So
Yeah.
in San Diego, both a commercial and a residential tenant can stop a landlord from pursuing a foreclosure if they
Eviction. Yeah.
eviction.
So
I'm sorry. Yeah.
if prior to the time rent's due, you inform your landlord like, hey, I can't pay rent. That can be an email, that can be a text. It just needs to be a prior notice before the rent due date. If you do that, within 7 days of giving that information, you have to provide documents supporting that. So I'm impacted by COVID because I lost my job, or I had my salary cut in half. And you can provide bank statements or a payroll record or a note from your employer, for instance, that speaks to that. And then if you do that, the landlord is prohibited from, evicting you, issuing a 3-day notice, or taking action to evict you for non-payment of rent. They also can't pursue a no-fault eviction. So that's what I thought was kind of a way to avoid an end around by landlords. So, okay, you can't pay rent. Well, I'm doing substantial improvements or repairs to the property and taking it off the market. Therefore, you're evicted. That all can't happen now if the tenant provides notice and documents that falls within that category, and then you're within that statute.
How long is this moratorium effective?
So California and City of San Diego is till May 31st. But more importantly, from the other angle, is the Judicial Council of California. So you have municipalities, states issuing eviction moratoriums. And again, these are eviction moratoriums, not rent moratoriums. All this rent is still owed in San Diego, for instance, within 6 months. In California, at May 31st, the time this thing ends, unless your local thing says otherwise. But the courts, on the other hand, have stopped all evictions. So on the one hand, you can't pursue an eviction, you can't issue a 3-day notice, but courts have stopped issuing summonses and processing eviction paperwork or issuing default judgments if an eviction was already in place. So what you're going to have here is a huge buildup behind this dam which is the court. All this buildup on one side, that once those courts open and once those Judicial Council lifts their moratorium, which is 90 days after Governor Newsom lifts the emergency order, it's just going to be a flood of commercial residential tenant disputes, and which probably leads, I think Mark can speak to this a little better, but negotiating with your landlord and tenant now. Because you're in the middle of things for a long period of time without much recourse.
So the governor's order does not have any sort of restitution component to it at all. And then the local municipalities have different restitution orders that are all over the place, but it is kind of a repeated pattern that as long as you repay the deferred rent during this period over the next 6 months, once the order is lifted, then, or within the 6 months following the lifting of the order, then you're in good standing. So there is a restitution area, time frame, a cure period, if you will, for you to repay the rent.
Is it in government? Is that in the Newsom order? Is that 6 months?
No, there's not.
No.
No. I wasn't aware of it, but it's just kind of what people are doing then.
No, so the way that Newsom's order works is it's over and you got to pay it all back.
Right.
Yeah. Which brings us back to bankruptcy. So, well, we'll talk about that later. But So Mark, this is a good segue for us. So let's talk about if you're a tenant, how do you approach your landlord? And if you're a landlord, how are you viewing what is going to be a wave of defaults on, and I think it's different for residential than commercial. So if you could talk about what you're seeing on both sides of those things.
So the residential side, most of the landlords, interestingly, are still getting, most of the ones I'm dealing with are still getting a good majority of their rents. They're getting enough to service their debt. They have reserves. They've done pretty well, and they kind of see this as a temporary issue, and they're not really all that panicked. It depends on the size of the property. It depends on how sophisticated they are, but by and large, you know, I've got one that where there's 12 tenants. I just worked on it yesterday. There's 12 tenants, and 9 of the 12 are paying their rent. So there's enough rent coming in. It's the typical, you know, smart investment you make as an investor in residential, where no one tenant's going to crush you. A couple tenants not paying isn't going to crush you. But yeah, if all 12 weren't paying, it would be a bad day. But you're just not seeing that. There's still enough people with reserves or income or what have you to pay their rent. And then most tenants realize they've sought, you know, the advice of people like me, where they realize that even if I don't pay my rent, it's not waived. I've still got to pay it eventually. So I don't really want to have that pain down the path of time here. It's in my best interest to pay it now if I have the money. And so they're doing that. And so I'm seeing that on the residential side. On the commercial side, it's feast or famine. There's people that have plenty of money to pay their rent, or it's just a complete bloodbath, and they just have no way of paying. And so those folks are coming to me, and I'm basically helping them put together a package. The challenge is how sophisticated is the landlord, and a lot of these landlords have been through this drill for so long, where somebody's not paying their rent, that they're treating it like a typical default, where it was because they couldn't run their business, or there was market forces that were in their domain that they had control of. So the typical knee-jerk response is, we want 3 years tax returns, they have to be audited, we want, you know, full financial, we want all this stuff. And it's like, I can show you what, you know, like the one that comes to mind. I had a chiropractor. He was treating 25 patients a day on up to March 15th. And on March 19th, when the stay-at-home order was lifted, he was seeing 3 a day. So, you know, what kind of empirical data do you really need to show your landlord to show that this thing had an impact on your income? And so a lot of it is understanding the nature of the beast. And then the other problem is that even the 6-month order is really not a solution. I mean, if you think about it, the way this works is the gates are lifted, or however you want to talk about it, the order is lifted. You still have to pay your regular rent that first day, and you don't have any business. You're not back up to speed yet. And then within 6 months, you got to pay back all the rent you didn't pay. I mean, it's a recipe for disaster. So what I'm doing with clients is I'm basically helping them package a business plan to take to the landlord for stretching out the time frame to make the cure. So let's start the repayment not the day after the order is lifted, but 6 months after the day the order is lifted. And then as opposed to a 6-month stream, let's do a year stream. I'm just using an example by, you know, just kind of example what I'm doing. And so we're pushing it down the line, and we're spreading it out over a meaningful period of time. And then by and large, I'm looking at the lease, and I'm sitting there saying, well, why don't we negotiate an extension to the lease for a couple of years? And then the tenant gets into a mindset where they get more comfortable about really putting together that package that the landlord wants anyhow. And it's a completely different tenor to the negotiations. It's not I want a bailout, but more, let's come up with a business plan together and go work together to go create this solution.
That's particularly interesting to me. So like, and we talked about this last week, and I think there's different things that as a commercial tenant you can offer a landlord that cost you nothing or almost nothing,
right,
and are very valuable to a landlord. You mentioned that extension of the lease as being a carrot that you can throw on top of the pile. John, I see you nodding there, and I know that you deal with this stuff a lot as well. Do you have any thoughts or anything that you want to add to what Mark's given us?
Yeah, I mean, I'm very aligned with what Mark is saying for the most part. I will say that I'm seeing a pretty interesting disparity between the type of tenant and the type of rent relief they're getting. Since this whole thing started, the majority of my day has been working out deals for tenants with their landlords. I would strongly prefer them to call Mark because he can build for it. I can't.
Which is why they're not calling me and they're calling you.
We're busy, but I don't know that we're busy making money over here. But we are getting deals done for tenants that need that relief with their
Just so my audience is clear, you do this for free?
You're recording this. I'm done answering questions.
We'll cut that part out.
So here's what we are seeing. Mark's right. The institutional side of things, it has been responding by the book. Pay your rent on time. There are letters that go out every so often to their tenants requiring them to abide by the terms of the lease. And then you've got the flip side to that, which is the mom and pops or the local landlords, and they're responding much more generously than the institutions are. And that's surprising because a lot of these people count on that income, but they come from a very understanding place. And so coming to the table and explaining to them what's happened in the business is really important. So the story, the business plan that Mark talked about is really important. On the institutional side, you have to hold them to the city ordinance effectively in order to get your rent relief. That's what I'm finding. And so that's a very by the book. You ask for the relief, they deny it within 7 days. As Chris mentioned, you provide them with the details that are required under the ordinance, and then you're allotted that certain period of time. But as Mark pointed out, that's going to be a recipe for disaster when it all comes due. So in many cases, so I'll give you a couple of examples. Breweries, for instance, we're getting 90 days of not deferment, just straight up rent abatement, period, end of story.
Wow.
I'm sorry,
Go ahead.
Aren't these people like, and this is the question that I get from everyone is aren't the landlords concerned that they're still going to have to go find another restaurateur to take over this space, and that these people have every ounce, the guarantees aren't worth the paper that they're written on, and these people are like, it's just, you can't move laterally from this position. Like, aren't they looking past, at least a 2-month horizon? I mean, like, what?
Again, though, it's very industry dependent. So on one hand, you've got the restaurant industry and the breweries and the people that, I mean, I was talking to a brewery the other day and he said, look, even if I had more beer to sell, which I don't because we're not brewing it right now, I wouldn't have anyone to sell to. I would have no way of getting my ingredients here. We're completely shut down. And so I took that story to the landlord and said, what do you want to do? Because all the breweries are giving me this story. So do you want to find another one that's going to give you the same story? Or do you want to work with the one you have? And the answer was, we want to work with the one we have. And they kicked out 3 months of absolute unequivocal rent abatement, not asking for the money back. We want you to be successful, because they were smart. And they're a quasi institution. So they're somewhere in between mom and pop and big New York finance, right? On the flip side, I've got a lot of law firms that can't make money right now because the courts are closed, but as soon as they open, they'll come back to making money. And the biggest issue for most law firms is whether or not they can actually collect money in a couple months when it's owed, right? I mean, I
was going to jokingly say that, but apparently it's not funny.
No, we represent a lot of law firms, and that's the case. They say, are our accounts receivable going to actually get paid? So, but landlords are less sympathetic to the law firm than they are to the brewery. It's just the nature of it. Right. What I think, and this is conjecture, I won't engage in a lot of this, but what I think will be really interesting is when stay-at-home orders lifted and people go back to offices, just how usable those offices are, whether or not the density of a call center is going to be usable anymore, whether or not these tenants can actually afford to pay those rents, right? Because, I mean, Cushman & Wakefield's a great example. They're rolling out a 6-foot office plan for tenants, and it's somewhat ridiculous, but it's where we are. It's a one-way route from an office with requirements to take paper, the same kind of paper that you'd wrap a Subway hoagie in, and put it on your desk, and it's a disposable desk service. I mean, there's crazy things that are coming to light as part of a process to deal with this. And we're all going to have to look at that. All right, so I'm done with the conjecture, but back to working it out with landlords and looking at Leo Klein's questions around whether or not tenants can constructively approach their landlords. Absolutely, yes. be prepared with all the details. They're all asking for financial information. They all want to know how disrupted your business is. Give it to them. Whether or not you have to, give it to them. It's not going to be difficult to show that you've been interrupted in some way in your business. And so that hire an attorney if you need to hire an attorney. Mark's very good at what he does. Mark was a broker for 30 years as well as a lawyer, so he really knows how to approach these landlords. And it's I would say that right now, working out deals, we've got a 85% success rate with landlords. And that repayment schedule is anywhere from the end of this year to the end of 2021 and everywhere in between.
Yeah, same. The other thing I would say, in addition to pointing some of the more institutional guys to the statute, is I also point them to the fact that the statute, it's specific. Go read the governor's order. It specifically addresses the orders from the Fed to give relief to the landlords, and they need that same documentation that they're asking the tenant to give them. So by packaging it properly for the landlord for the rent relief, you're actually setting the stage for the landlord to repackage that exact same data for their lender. And so it's, help me help you. And so once you make them understand that, look, the business plan isn't just for me, it's for both of us, you get a different response.
Right. Yeah, I wholeheartedly agree with that. And by the way, just to add this on, a lot of landlords are requiring tenants to apply or get PPP financing in order to cooperate with them. And I'm not just talking about San Diego here. That's more of a big picture scenario. But a lot of them, their protocol is, let's see if they can get the loan. That loan can be used to repay us. It's a little bit of good money after bad versus using the PPP as a protocol to give some kind of rent deferment. And I'm seeing a lot of landlords point to that at first, and then you kind of have to walk them back from it.
That's part of the business plan that I'm putting together. Is I'm actually telling my clients, one of the things is if they were a bad tenant before, I won't work with them. So if they've been in default and they were having problems before, or they were just a bad actor, I just won't work with them. This is a catalyst. But the other thing I'm telling them is that, you absolutely have to go apply for that relief, and part of that business plan, build that up. The last thing I would say that we're ignoring here a little bit, not purposely, is they have to look at their lease. So all the provisions for how you give notice and how you deliver this information, and a lot of times there's a preemptive strike you have to hit with a notice of default as a landlord that isn't the 3-day notice. It's an intermediate step. And if you don't procedurally go through that step, you're going to be in a bad place when you ultimately do want to or need to evict. So don't ignore the provisions of the lease. So the process is, first you figure out what municipality you're in. Is there some overriding order? You then look at the government's order. You look at the judicial order. You layer them all together and you figure out what are the rules of engagement if we agree to nothing. So you understand what that is. And then the final layer of that is, what does the lease say? And you've got to bring that into the analysis. If you're not looking at your lease, you're going down a bad path.
Well, which leads us to, you mentioned the word conjecture, which I think is probably more fun than dealing with reality these days. But so Sean O'Neill was supposed to join us from U.S. Bank. He had to drop off at the 11th hour. But we have enough experts that deal closely enough with SBA lending. So let's segue into what. First of all, before we do that, have I addressed all the questions?
There's one about landlords accepting higher deposits. I think more on the residential basis. AJ,
okay. What are your thoughts on that? Yeah, I saw that from Susan. So. Are landlords asking for higher deposits, or are they asking for new residential leases?
I'll comment on the commercial. I'm not seeing that happen on the commercial side.
Mark?
I'm not seeing it either, but the challenge for deposits is that you can only apply a deposit to rent that is actually accrued. So if you're going to take a deposit and there's not, the rent hasn't come due yet, you can't apply it anyhow. So I'm not sure what that really gains you if you're taking, massive deposits. So.
There's one about a residential buyer getting out of real estate and submitting cancellations before contingencies. How can COVID-19 play into cancellation requests while still allowing the buyer to keep earnest money deposit? Do you guys see that from Stephanie San Antonio?
Yeah, I answered that. I didn't know if she was in California or not, but I'm assuming Texas would have similar laws. Like I said, that there's new documents that can come out and you can put into place at any time, even if it's in the middle of a transaction, and say, hey, the Rona did this and I can't do this transaction.
Yeah,
but
I mean, from
that's
a legal
elected between the that's elected between the parties. They don't have to agree to that.
Yeah, but she's talking about before contingencies are released, and I mean, broadly speaking, if you cancel before contingencies, it's going to be really hard for them to keep your deposit. I mean,
yeah. I mean,
like it's just, I mean, you might have a substance over form issue, but just as a general practice, like if you haven't released, I mean, with the exception of the loan, sometimes you'll release everything but the loan contingency. But if you've got all your contingencies in place, then and you cancel, like you can cancel because someone looked at you funny. I mean, I'm probably using a little hyperbole there, but like it's just from a legal perspective, it's going to be really hard for them to keep your deposit. So,
agreed,
especially in this environment. Yeah.
So AJ, I wanted to mention on this because, this is something that I'm finding because there's been a lot of misinformation in terms of the payment deferrals. And Mark alluded to it earlier with the leases that, hey, you might be able to postpone your payments on your leases, but eventually you still owe them. And I think a key point that I think people need to know is that if you need to defer your mortgage payments, you could do that. But if you think you're going to refinance your purchase or get a new loan, it's still going to affect your credit adversely. Even if they're not going to mark it as a 30-day late, it'll still show up as a forbearance. And when I'm talking to my mortgage guys, they're saying they're going to still ask you for your bank statements or a VOM that say that whether you did pay your payments during this time. Because if it's not showing up on your credit report and it's got some kind of note that there was some kind of plan or a forbearance on your credit report, which the mortgage companies are saying they're going to do, that's going to impact your ability to refinance. Because now you're not 0 for 30 for 12 months.
Wow.
That's crazy.
So that's a huge point you got to know. So if you can afford to make your payments, please do so, especially if you think you want to do some kind of loan transaction, a refinance or a purchase in the next 12 or 24 months, because they're going to be looking back at this time. And there's no crystal ball at how much leeway they're going to give with you missing payments during this time, because this is a big issue. But at the same point, if you're not trying to game the system, you can afford to pay those things, then pay them so you get your best chance to refinance out of it or purchase a new property when the time comes.
I referred to this time as the Wild Wild West. It's just, there's no rhyme or reason to one set of group giving relief and another one not giving relief. And, you see that the IRS is given an extension before taxes are due, but the county assessor wants their property tax right now. It's, you see the Fed saying to the landlords or the owners, you can defer your payments, but to actual, borrowers, we're going to ding you on your credit. And it's all over the board. It's a mess.
Yeah, no, and that's why we're doing this candidly. Like, I think the only way to get real information out to people is to talk to people like us who are dealing with this stuff on the front lines. As I was mentioning before we went into this last segment, but Sean isn't with us. So we're going to segue into something that I would consider to be a little bit more subjective. Looks like Kishore has a question up here. Please explain if the rules of eviction noticing residential property are similar to the ones for the city of San Diego. Kishore, we actually did county versus city of San Diego. Chris, do you know the answer to that question?
Yeah, I believe it is similar. I mean, the details might be slightly different, but the general principle remains. I mean, pre-notice, documents post, the time for repayment might not be 6 months, but I believe they are the same. I need to double check that. I can send you an email, Kishore, and let you know.
So I have a file of those, and I've got 28 different ordinances. So, I mean, just pick a municipality. I probably have it in my file. It's crazy.
Yeah.
So just kicking this around, like, like I said, Sean's not with us, so I do want to talk a little bit about financials with the understanding that the people on this panel are not bankers, but we are banker adjacent is what I'd call it. So we deal with a lot of bankers. We're friends with them, but I wouldn't let them date my daughter. You know, like I don't have a daughter, so it's a complete joke. So, you know, it's one of these things where we are journeying a little bit into what I would call less of a subject matter expertise range here. But I want to throw around this, like, what happens as a landlord when you default? When you're in this position where you are now missing rents and you're trying to approach your lender, what are some best practices around that type of information? And Mark, I'm going to have you start this conversation off for us.
So I'm sorry, we're talking about a default with a landlord. You haven't paid your rent?
Yeah, landlord lenders. How do we start that off with in the commercial context?
Well, I mean, again, it's kind of back to what I was saying. You don't want to default. You want to give notice. You know, there's no reason to hide. It's kind of like what John was saying. You know, be prepared to give the information. So the best defense is a good offense. And so you don't want to get to that point where it's past the due date. You don't want to give that notice. But if you look at these ordinances and you look at these statutes and just the way that the relief is out there, there usually is some sort of a grace period, but I wouldn't let it go past, 7 days. I think you've got to make sure that you're talking to these folks. But the last thing you want to do is go dark.
So that I understand what we're talking about, though, you're talking about a tenant defaulting to a landlord and then that trickling back to the lender?
Yes.
Okay, so I'm seeing a lot of landlords calling their banks proactively.
Early.
Before tenants have even given them any notices, because they're preparing for that. And I know in one instance, there's a bank here in town that does a lot of real estate deals, and they've been very lenient with their borrowers who have been in good standing, trying to weather the storm with them rather than just holding their feet to the fire. So I'm seeing a lot of proactivity between the landlord, the building owners, and the banks trying to deal with that problem together. Occasionally you'll have a tenant that takes advantage, and that's kind of an exception to the rule right now. I think most people are actually damaged by this. And I see lenders very much cooperating, and that goes back to the very beginning of this conversation. Part of the extra runway that banks have right now is the result of the lowering of rates and giving them the ability to create some runway for themselves. And it's for dealing with this kind of stuff.
And they have the relaxed rules by the FDIC and other Fed agencies and other directives. So they don't have a lot of pressure on them right now. And so they're very forgiving.
Banks still are lending though, AJ. Banks have not stopped lending. Their underwriting the scrutiny's gone up. They're really looking at the financials and the borrower and looking at whether or not they can weather the storm. And there's, like I said earlier, there's talk about debt coverages adjusting and that kind of thing, but banks are absolutely still lending, and they're doing it both on the owner user SBA side, 504 and 7A. And there's also conventional financing available. We're doing deals right now between 3 million and 20 million of those active deals that remain. And nobody seems to be backing out. They're asking more questions.
Interesting. Henish, I know you do a little bit of work on the residential side with workouts and things like that. What are some of the programs that are available on the lender side for loan workouts on the residential side?
Yeah, I mean, everyone's kind of offering blanket deferrals. Like out of curiosity, I inquired with my lender. I was like, hey, what are you guys doing? And they just responded back like, you've been approved for a deferral. I'm like, I didn't even apply, but thanks for the blanket deferral. I still sent my payment in when I found out that they were going to count it as a forbearance account. But, I wanted to inquire and see if they were going to give me an option. But there's so many different servicers out there, and there's no black and white rules. So they're kind of making judgment calls, right? That bank that I called 3 weeks ago, they're like, we don't know. We don't have anything yet. And then 2 days ago, they said, your deferral has been approved. And I didn't even apply for one, so they just kind of, I don't know if they just blanket sent that out to everyone. So people are getting the opportunity to miss their payments without it being reported or affecting your credit score. But like I said, I think that that's going to turn into issues when your new lender is doing a verification of mortgage or checking your bank statements and seeing that if those payments were made those months, then you can't report that you missed 0 payments, right? And that's going to be the issue. That's the crystal ball in the future of whether they're going to forgive you for missing these payments during this period.
Yeah, no, so it's back to that question is well, what happens when we hit the brick wall, when the forbearance is up or the time is up? Okay, so I'm just going to go through the chat room here. Any other questions that you guys are seeing on the Q&A or otherwise that you think we should address here?
You know, I've heard something come up a number of times that may be more interesting for another panel, but that's whether or not there is an event of default if you're following the city ordinance, and what happens in a commercial lease if you follow the ordinance. Does it actually trigger an event of default later? And that's for some smarter attorneys to figure out, like you guys.
Yeah, I mean,
go ahead. Yeah, I'm trying to jump in on your territory, Chris.
No, chime in when you want. I mean, that circles back to the force majeure thing, I think. I mean, if you can't perform, if you're required to stay home and not do something, and this is the vague question, but if you're required to stay home and do something, I'd argue performance is impossible at that point. And if that's covered in the force majeure provision, it's great. Even that's the best situation. But there is a statutory basis for the same impossibility or impracticability that would justify or delay that performance. So it wouldn't necessarily be a blanket, you're fine, you're free, but it just delays that performance to whenever you can then do something. And at that point, is it even feasible to do anymore? I don't know. But if it's something, opening your business by a certain date, that's not possible anymore given the government action. And then you just delay that down the road. But if it's something that's more, malleable, I don't know if you could really mess with it.
Bob has a question, and this is kind of a Henish question. Going back to an earlier topic, what are you seeing in the market for buying older, smaller homes near the beach for tear down to build McMansions, La Jolla, Encinitas, Corona? That's Henish's backyard. So why don't you?
Yeah, I live in PB. I mean, yeah, it's a good opportunity. I mean, but the thing is that it's just going to be what's going to be your potential future availability of credit and capital at that point. I'm not sure. You can't base today's loose lending requirements on what you might get in a few months when prices start trickling down. So keep that in mind. That's where it helps to have friends like Mark that seem to have people that just want to give them money on first deeds of trust, because maybe those people will lend it 7, 8, 10, 12% to get you your property, especially if it looks like it's a good value. So it's good to have some friends with money when the market tanks, because the lenders might be offering those same 7, 8% rates on the back side of this thing if you're trying to buy those things, especially if it's a construction loan. You figure you still got to put down at least 30% and maybe even the construction amount. So it can get expensive. You got to be cash heavy to be able to do those teardowns.
And that's exactly what Bob pulled up afterwards. What if you're paying all cash? I mean, if financing isn't an issue, are you seeing values in those beachfront teardowns right now? I mean, I rented one of those beachfront teardowns. It had a cost basis of like $120,000. Like the guy's great grandmother must have bought this thing. And so like it was one of those things where, my instinct is these ones that haven't been torn down and rebuilt, it's just old money. They're paid for. They don't have a lot of impetus to do anything, and they'll always be rented. But what are you seeing?
Yeah, I mean, there's definite value in that. I live pretty close to the beach in Pacific Beach, and that's just what happens. Any older house that was built before 1970 is getting torn down, and then they're maximizing FAR, and they're putting 3,000 square foot houses on 6,000 square foot lots because the FAR is 0.5. That's just what makes economic sense in those areas. On the flip side, you're also seeing people building 2,000 square foot houses and building 1,000 square foot guest houses or ADUs, because now they can use that rental income from the guest house to offset the cost of living. And people are finding that they can live in smaller houses. You're seeing a trend in the builders as well. They're saying this year has been the smallest size houses they're building, with an average of 3 bedrooms. So now, after years of increasing home sizes from the builders front, now they're decreasing them again. And people are realizing they don't need 3 or 4 or 5,000 square foot houses. 2,000 or 2,500 or less is plenty. But yeah, to flip houses in the beach area, the rents are still going up, the values are still going up, and until we get overtaken by climate change and we're underwater, I think being close to the coast and having that coastal climate is still always going to have an appeal and a draw. What you see from the last recession and other recessions is that different asset properties, whether it's single family, condos, luxury properties, and depending on what part of the community you're at, whether you're rural or walkable, every area gets impacted by value decreases and increases differently. So it's hard to say a blanket statement. I feel like the beach areas are protected the most because there's always going to be mild to strong demand there. It's not like you're going out into rural areas where at a certain point, there's going to be very few buyers, regardless of the price point. Whereas in coastal California, $1 million for a piece of land close to the beach is always going to be worth at least $1 million.
Yeah, no, I tend to agree. I just like there's just so much there's so little supply in those coveted areas. It's just, you know, I remember looking at this thing back in the day, and 2010 was just the absolute middle of the forest when everything was burning down around the housing market. And we were doing, 15 bankruptcies a month. And I looked at property valuations in La Jolla. They were down 4.5%, 5%. I mean, it was like almost unimpacted, while Chula Vista and San Ysidro were down sometimes as much as 70% from the peak. So, it seems to me like those regions, it's really, really hard to find opportunities in those arenas. So,
well, there's a finite number of buildings that can see the water. I mean, it's such a small ratio that they should be insulated.
Yeah. Guys, we're hitting 5 o'clock, and I do think that we could do this all day, especially with this panel. We really, we started actually at 3:30 with this really interesting, and there's a part of me that would love to talk about lending and CMBS and some of the topics that we were talking about earlier, but I do want to keep this to an hour. My instinct is that people start to want to fall asleep, but
AJ, I saw a few questions come in that I wasn't able to pull up. So just if you could send those out to us so we can see those if there's something we want to send somebody an email just to answer those questions.
Does anybody see any questions that we haven't answered already?
There's an Airbnb one that just popped up from Dylan. One of the things I've done is that I've put my property for rent on the MLS, and then that syndicates out to like 40 different rental websites. So I'm renting it as like a furnished executive rental unit. And so I'm starting to get pings from business travelers or traveling nurses. So even if you're not getting the vacationers, people are still working and traveling for business. And they might prefer a place with a kitchen instead of staying at one of the vacant hotels that we've got.
Right.
And you may find somebody working from home that doesn't want to work from home anymore.
Oh, interesting. Right. Interesting.
Or can't.
We've got several brokers in the commercial arena that are doing that. They're renting beach houses to get away from their family.
Yeah, I know several that have gone to Palm Springs or the beach or whatnot just to get out and get some amenities at their house.
A little staycation, yeah.
Exactly.
I want to buy a boat.
I'll admit to using the pool at some of my vacant listings with my family because I don't have a pool at my house.
I want to get a friend that has a boat.
All right.
Yeah.
I'll be that friend.
All right, guys, I'm going to wrap here. I'm looking forward to doing this again. I don't think that this is the new normal as far as I'm concerned. I thought this was a great panel. To any of the panelists, if you're interested in doing this again, just ping me. I think we could probably do this again in 2 weeks and have an equally interesting discussion. But this was great. I thought we did a fantastic job of really covering a lot of bases here. And I appreciate everybody's expertise and their willingness to share their time. Thanks, everybody. Thanks for participating.
Thanks, guys.
Thank you.
See ya.
All right.